He's a CNBC contributor. And I referenced you earlier because I do remember you sort of being positive overall about the market and for this year, but with some trepidation near term. And most of your calls recently have been less on the strength of the economy and more on inflation data. And some of your, like when you were calling things, S&P is going to end the week, 8% higher because of inflation or something. So we got inflation this week. There are concerns. I think I tie a lot of the weakness in the market to that. Are these important numbers?
It's important because, as you know, we've been correcting now for almost a month, right? 23 trading days. And this Wednesday is an important day because it is a possible turning point for markets. And I would like to see CPI come in below, 0.25 or so. And I think that would give that jolt of confidence for markets on top of, I think, earnings, which is going to be a positive catalyst. But for investors in the near term, I think they got to ride out the volatility because I think yields here have made people nervous. Not necessarily deteriorate the long-term outlook, but near term.
Are they smart, the yields, or are they not giving us the correct signal? Because you sound really like you're not sure about the inflation data this week.
I'll have a better sense over the next couple of days as we sort of finalize what our expectations are. But the only hesitation we have is that the hurricanes last year have muddled some of the inflation quality because, for instance, hotel reservations would go up because of these natural disasters, and it's going to happen now with the LA fires, and I think it's going to muddle used car prices as well because you have to replace all these used cars.
So you think if they weren't muddled, that inflation isn't that big of a concern? And when you say a turning point in the markets, if we've been down for a month, turning point doesn't mean further weakness. You think we might be making...
That's good high-level thoughts there, and I think it even makes me think about Tesla. Like, could you imagine how many just Teslas burned up in these fires? And honestly, they're still going, so it could get worse. But I'm just thinking it's got to be a lot of dang Teslas. Like, we know California, they own the most Teslas by far and away versus pretty much anywhere else in the world. It's insane, right? And so I could just imagine how many 3s and Ys and S's and X's burned up in those fires. That's crazy to think about, right? So yeah, there's no doubt that's going to definitely be kind of a boom for, some either new cars or used car prices. It just is what it is.
A bottom this week?
Yes, our technician Mark Newton thinks 5,700 might be the turning point. It could happen Wednesday, so maybe 2% down from here, but that's really where the market could make a stand. I think if we could lift the cloud of some of this muddling, in fact, Waller last week even said most of the inflation last year was about imputed prices, meaning the real price of inflation was actually much lower. I think that is still the case. Inflation is weaker when you look at housing, et cetera. So once we can get through that noise. But investors, I think, shouldn't be too glum. I think earnings season is going to be something that really solidifies. Look, if S&P earnings growth is 10%, X energy and revenue growth 5%, that's a really good reason to be owning equities.
Is the Fed less significant right now with their rate cut? I don't care whether they, that's not what I base what the market's going to do on. Are people still just dying for another couple of cuts, or I think we're lucky to have gotten what we've already gotten. We ought to live with that and just try and hope inflation doesn't come back.
I agree with you. I think the best case this year would be the Fed doing one cut because the economy is strong enough and they're still dovish, meaning they're going to make their way to neutral. But if they push those rate cuts into 2026, 2027, that's a longer run rate to support markets. Part of, I think, the hesitation for stocks right now is we have a new administration starting.
What? Oh, that's right.
Yes. And, we've essentially reversed that rally from November because we rallied 7% over 23 trading days. Mm-hmm. And now we've given up 5% and another 2% would just round trip us back to November.
23 trading days.
Do you think stocks look expensive here or not? I mean, we've come back down, as you mentioned, but people keep talking about the PE ratio and how...
I don't know why, but the way Becky Quick just approached that whole situation, the way she was talking and holding her coffee cup, just made me think come on, dude, Are the stocks going to go up, or what's the deal?
It's
Are they
trading.
expensive
Do
or
you
not?
think stocks look expensive here or not? I mean, we've come back down, as you mentioned, but people keep talking about the PE ratio and how it's historically at the high end of things. Do you think it's expensive, or do you think we have the earnings power to support all of that?
To me, the 10-year, even if it gets to 5%, is a 20 PE multiple on a 10-year bond. Mm-hmm. The median PE on the S&P is 17 times. So I think stocks are giving you much better value than a bond right now. And 5% is probably not the level that yields stay at. It's probably a deflection point.
Tom, what does the movement in Bitcoin say to you? So we're at 91,000. What is that? What is that a signal or a sign of anything in this sort of analysis?
Stupid Fed.
Yeah.
It's not cutting.
Yeah, Bitcoin's down roughly 15% from its highs, which for a hyper-volatile asset is a pretty normal correction. And it is slightly following global liquidity, but we're pretty early in this halving cycle. So to me, I think Bitcoin in the near term, again, our technician thinks 70,000 is where we can sort of make a stand. Means you're getting a big opportunity because I think Bitcoin's going to be one of the best performing assets.
So hold on, but you still think it goes all the way down to 70,000, or you think that's the floor, in which case you would still buy at this price?
Yeah, so there's Fibonacci's. So one level would be 70.
Let's say that again.
There's retracement levels. So you pull back from where you rallied.
Right.
So 70 is one level. It could go to as low as the 50s. But that's, again, not a new level. It's just where it touches before it begins to rally.
Okay, let me ask you a different question. For those folks who are watching who are not in Bitcoin or are thinking about buying Bitcoin at these prices, are you saying that this is a fair and good price to get in, or are you saying wait because you think it's going farther down?
You know, Bitcoin is something you need to be long-term focused. I don't think anyone's going to lose money buying here at 90. If they're trying to time this, maybe they'll get lucky and it goes to 70. But to me, Bitcoin could be significantly higher this year, maybe 200, 250. So I think 90 is still a good entry point.
So let's be very crystal clear. If Bitcoin goes to 200 or 250 this year, let's be very crystal clear. The market's going beast. Like, NASDAQ's flying. Like, there's just no way around that. You can follow Bitcoin for the last many number of years, right? And you're going to see clear correlations. NASDAQ goes beast, Bitcoin goes beast. NASDAQ sinks, Bitcoin sinks. Like, they both roll together, right? 2022, horrible year for Bitcoin, also a horrible year for the NASDAQ. If you look at, coming off of the Rona lows to the end of 2020, great for the NASDAQ, great for Bitcoin. If you look at 2023, great for the NASDAQ, great for Bitcoin. You look at 2024, great for the NASDAQ, great for Bitcoin. So at the end of the day, like, if Bitcoin does have some great year where it goes to 150, 200, 250, something like that, do you know what's going to happen with that NASDAQ? Like, we're going to be talking about Meta is going to be $1,000 plus at this time next year. Like, it's going to be ridiculous. Like, the moves are going to be parabolic if that was to play out. So I'm not nearly as bullish on all that as he is, although it would be very welcome. Okay. How would you like access to all my best course curriculums? My Becoming Master of the Stock Market course, my Stock Market Investing Mastery course, my Stock Options Mastery course, my Millionaire Playbook. How would you like access to all my best courses, as well as the ability to have access to my 6- and 7-figure plus Discord community, where we're constantly keeping in touch with each other, talking about what's going on in the market? How would you like exclusive weekly videos from me? How would you like the ability to see what stocks I'm buying and selling in my $2 million plus Fidelity account? If that all sounds pretty interesting to you, apply to join my private group. That is going to be linked in the description area down there. You can click on that, fill out an application, and go ahead, hop on a call with Andre. Andre will walk you through the whole process. He'll walk you through the whole group, and you can go ahead and join us in there. Once again, the link for that is in the description area. Alrighty, guys, where I want to start here, this might be surprising to some folks, but I actually want to start this video talking about Bitcoin. Yes, Bitcoin. And the reason I want to start today's video talking about Bitcoin is Bitcoin tells you a lot. It tells you a lot about where investors want to position, how they're thinking about the market moving forward. It tells you a whole story. It really does. And so even if you have no interest in owning Bitcoin, right? Perfectly fine. Always have Bitcoin on your watch list. Always keep an eye out because it's going to tell you an entire story here. For instance, right, if you look at Bitcoin's returns, since it became a more mature asset, which it really got onto the mainstream financial landscape, I would say around 2018, 2019, right? And then just kind of got more and more mainstream over the years, where now it seems like just everybody knows what Bitcoin is, right? But you got to understand, Bitcoin is basically a call option and put option on the NASDAQ, okay? It's been that way, and I see it being that way for quite some time to go here in the future. So essentially, whenever Bitcoin's going on a beast run, the NASDAQ's going on a beast run. But the difference is Bitcoin's going to be way more extreme to the upside. Now it also works in the downside. So let's say the NASDAQ goes down in a particular year. The Bitcoin's going to be way more extreme in terms of its downside risk versus a NASDAQ. So that's why I call it a call option or put option based upon where the NASDAQ essentially is moving, right? And you can see this played out, right? So look at this. So Bitcoin down year 2018. Guess what? NASDAQ down year 2018, right? Bitcoin up 89% in 2019, right? I bet you the NASDAQ had a great year in 2019. Oh, did it ever? The NASDAQ was up 35% in 2019. In 2020, the NASDAQ was up 43%. I bet you it was a banger year for Bitcoin in 2020. Oh yeah, 302% gain for Bitcoin in 2020. Almost a 40% gain for Bitcoin in 2021. I bet you it was a good year for the NASDAQ in 2021. Oh yeah, it was. 21% gain for the NASDAQ in 2021, right? 2022, NASDAQ got obliterated, down 33+%. I bet you Bitcoin got hammered. Oh, did it get hammered? 65% down. And then 100% plus gain in 2023 for Bitcoin and 100% plus gain in 2024. Oh, guess what? NASDAQ, banger year 2023, 43% gain. 2024, 28% gain, right? Bitcoin's going to tell you a lot. And so what's Bitcoin telling us recently? Bitcoin's telling us that when I say ultimately, I think investors want to take more risk. They do. If you look at the trend here very recently in regards to Bitcoin, it looks to me like people are about ready to start taking risk on the market again, right? Because that's the story Bitcoin's telling us. It basically over the past month, it's been telling us a story of like investors are uncertain, right? And very, very recently here, it flipped in a massive way, and now it looks like investors are ready to take risk once again, right? Now, additionally, I don't know if you guys follow me on the Reaction channel. Jeremy Lefebvre Makes Money, right? But I did a video yesterday. I was talking, at the beginning of the video, I talked about Fubo, AMD, and Cake, right? But then from there, I reacted to a few videos, which I pretty much always do on that channel, right? But one of those videos was Tom Lee. Tom Lee's making a call that Bitcoin's going to 200 to 250,000 this year, 2025. By the end of the year, you'll be flipping my flapjacks. Let me be very clear about this. If Bitcoin goes to 200 to 250,000 this year, what do you think is going to happen to the NASDAQ? What do you think is going to happen to the S&P 500? It's going to be a booming year. We're going to be talking about another year where the NASDAQ appreciates 20+%. Where we have another year where, the S&P 500 goes up 15 to 25%, right? And people will be like, oh my gosh, we just had 3 back-to-back-to-back banger years in the market, right? But remember, 2023 was this is what people got to understand about this, right? 2023 was just a get back of what happened in 2022, right? 2022, stock market got hammered. 2023 was like, oh, let's get back on track. From there, 2024 was a building year. 2025 could be another building year. No guarantees here, and we got a lot to go through in this video here today, but that's the way you got to kind of frame this. If 2022 was a banger year, and then 23, and then 24, right? I would be much more concerned about 25, but 23 was just a get back of those 2022 losses. That is what is important to understand about this, and that's a part a lot of people conveniently forget in regards to this whole story. Now, I don't like what I see. Look at GSG. I always tell you guys, keep this on your watch list. GSG, commodity index, basically, right? It's kind of a basket of commodities, kind of tell you what's going on in the commodities cycle. And at the end of the day, everything in this world goes back to commodities, right? You want to make basically everything, it ends up going back to commodities, right? So I don't like what I see here. And the reason being is GSG is now up about 14.5% in the past year. But specifically, the much more worrying thing is the move in the past, I would say 4 or 5 months has been rather dramatic for GSG. Specifically, since around the time the Fed made those first rate cuts, right? GSG has been up and up and up, and now we're looking at GSG at the highest point it's been at any point in the past year. And why is this? Well, it's because of crude oil. If you look at crude oil futures, I mean, look at this, 12.7% move in the past month. Guys, it's wintertime right now. I'm recording this in January, mid-January. Like, a lot of times you expect crude to move up in spring going into summertime, right? Obviously, major driving season, people taking trips, all that, blah, blah, blah. So a lot of people expect crude to move up in spring, move up into summer. But when you got crude moving up huge in December into January, definitely something you got to keep an eye out, and definitely something that could cause potentially problems here, right? What's going on with crude? Crude rallies. Crude and gasoline prices rallied sharply Wednesday, with crude posting a 6-month high and gasoline climbing to a 3 1/4 month high. Wednesday's weaker dollar is bullish for energy prices. Crude prices extended their gains Wednesday after weekly EIA crude inventories fell more than expected to a 2 3/4 year low. This is something to keep an eye on, guys. If I can tell you, if commodities keep running and running and running month after month after month after month, we're going to end up in, guess what? Inflation problems again. And that's not going to be fun for any of us to go through, right? Look at this here. What I'm showing, this is out of the government, okay? Real average hourly earnings for production and non-supervisory employees decreased 0.2% from November to December. That's not good. Now, you can't just make a justification based upon 1 month and say, oh boy, we're in trouble here. Because at the end of the day, you look over the past year, and clearly there's a trend of real wages being in a good spot, right? Which we need real wages in a better and better spot so the consumer can go buy a new pair of freaking Nikes, okay? So the consumer can go buy a new iPhone, so the consumer can go buy a new car, so the consumer can go eat at the restaurants, right? That's what you have to have a good economy. You need real wages to continue to tick up. But recently, if we start talking about real wages going negative again, that will lead to problems in the overall economy, okay? So this is like early indications of like, ooh, and this is part of the reason I believe you're getting a lot of this recent kind of weakness, like unsure market right here recently, is kind of looking at some of this stuff in the market saying, boy, okay, we want to see this, we don't want to see this here, right? How would you like access to all my best course curriculums? My Becoming Master of the Stock Market course, my Stock Market Investing Mastery course, my Stock Options Mastery course, my Millionaire Playbook? How would you like access to all my best courses, as well as the ability to have access to my 6 and 7 figure plus Discord community, where we're constantly keeping in touch with each other, talking about what's going on in the market? How would you like exclusive weekly videos from me? How would you like the ability to see what stocks I'm buying and selling in my $2 million plus Fidelity account? If that all sounds pretty interesting to you, apply to join my private group. That is going to be linked in the description area down there. You can click on that, fill out an application, and go ahead, hop on a call with Andre. Andre will walk you through the whole process. He'll walk you through the whole group, and you can go ahead and join us in there. Once again, the link for that is in the description area. Now we go back to inflation. The reason I want to go back to inflation is because so many things end up coming back to inflation, right? So U.S. consumer prices post largest gain in 9 months, underlying inflation slowing. So the latest CPI numbers that just came out, 2.9%. That's good. Like, if we can have CPI anywhere between 2.5% and 3.5%, we're good. Like, fine. Like, that's what we've traditionally had, and we've had very healthy economy with inflation rates somewhere between 2.5 and 3.5. The issue, though, is if you look at the trend, what is the trend? The trend is higher for CPI, which means if CPI just keeps going up, inching up, and next thing you know, it's at 3, 3.1, 3.2, 3.3, the Fed's not going to be able to lower interest rates in the next 6 months, the Fed funds rate, right? And if they can't lower Fed funds rate in the next 6 months, the market might get a little concerned about that because the market was hoping that the Fed would be, let's call it going much lower over the next 12 months. Now, keep in mind, even the Fed lowering recently has obviously spiked Treasury yields, which, that could be seen as a negative thing that hurts the market. So the Fed lowering, I think the market got a little confused and think things it's like easy, like the Fed just lowers rates and, it's all up and up and up. Not really. And that leads us into the real estate market, right? And the real estate market can be very tied in with the stock market over time. But here recently, mortgage rates are back over 7%. I'm sorry for anybody that's looking to buy a house out there. in the next few months, brutal, man, brutal. I think it's brutal for buyers and sellers the next 6 months, because for the buyer pool, they're looking at it and they're like, I got to pay 7-something%, right? Like, that's kind of crazy. So that takes a lot of buyers out of the market. They're going to say, screw this. I'm not buying right now. Just forget it, right? Sellers, on the other hand, if you're trying to sell a property with a limited buyer pool, I don't think you're going to have much for pricing power. I just don't, which means I think it's just, once again, kind of a stalemate market. And I think it's just a brutal market if you're a buyer or seller right now, right? And the reason being is if you look, from basically 2008 through 2022, everybody's got brainwashed into thinking 3 to 5% mortgage rates is where you're going to be, right? So when all of a sudden you're talking about being 7% plus, when everybody is in this mindset of 3 to 5%, it's hard to wrap your head around that. It's hard to think like, I'm going to go sign up for a mortgage at 7.1% or something like that, when you might have a mortgage rate now at 3.1% or 2.9%, right? Or 4.1%. Like, whatever your number is, it's probably way lower than where things are at right now, right? And obviously it hurts affordability in a substantial way. That leads us into the national deficit, which currently we're already at $711 billion in the hole already in this fiscal year, right? Which is around a 39% worse number than at this time last year. That's how bad things have really gotten national deficit. And a lot of that has to do with interest. In 2025, interest payments are projected to be $1 trillion. $1 trillion. That's insane, right? The national deficit's out of control. What's going to happen in regards to this? I don't know. Because the thing is, if you really want to bring down the national deficit, we're going to need to take some short-term pain for a few years. If you really want to bring down the national debt, that's also going to take a lot of pain. And I just don't think politicians are ready to take that pain. And the reason they're not willing to take that pain is because the people aren't willing to take that pain. And as soon as here's the thing, if you really want to bring all this stuff down, it's going to end up hurting GDP. It's going to end up hurting jobs. It's going to end up hurting a lot of people. And guess what happens when people are hurt? They vote out the current politicians. And the next ones are voted in, right? That is, say they're going to save the day and they're going to do this, and they're going to do that, and they're going to spend more money, blah, 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 right? So that's a whole situation that's going on. No. People might think hiding in treasuries is like the smart move, right? Because you look at stocks, you might say, markets, it's not at all-time highs, but it's toward all-time highs, right? You look at Bitcoin, same exact thing. You look at real estate, not ideal. So you might think hiding in treasuries is a smart move. But hiding in treasuries is not always a smart move, even if you can get that guaranteed 4 to 5%. And here's why. Think about it like this, right? The public account in January 2023 was around $1 million roughly. Let's say I had that $1 million just in treasuries over the last couple of years. Right now, the public account would be sitting somewhere between, I would guess, $1.1 to $1.2 million, right? That's what I would have in the public account. Instead, because I'm in individual stocks, I have over $3 million in the public account, not 1.1 mil, right? So we're talking about a substantial difference. You might say, well, that's just because you're in a lot of great stocks that have gone up a lot over the past couple of years, like Meta, Elf, blah, 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 right? Palantir, all those stocks. Well, even if you'd been in the S&P 500, you made over 20% gain in 2023, right? You made over 20% gain in 2024. And versus treasuries got you a maximum of what, about 5%? So even if you had just invested in S&P 500 index funds, you destroyed the returns versus treasuries. So I understand, like, it can be very tempting to say, I'm just going to park my money in treasuries. But as somebody that knows several high net worth individuals, top 1%ers, right, that have been hiding in treasuries the last couple of years. And you know what they tell me when I speak to them? Jeremy, did I mess up? Why didn't I just put in an S&P 500 index fund? I didn't even have to do individual stock. I could have just done an index fund and made 20+% per year. I mean, if you're talking about combining that total together, you're way over 50% gain versus maybe 10%-ish gain in treasuries. Huge mistake. So I understand, like, it can be very tempting, but a lot of times the smartest, it looks like this is the smartest place to put money. A lot of times it ends up not being that, right? Now, I want you to pay attention to this right here, because S&P 500 is technically down so far to start the year, right? But here's what's interesting about this. If you look, the S&P 500 usually what? Goes up. in January. Usually January is a very good month for the stock market. So we have one of two phenomenons going on here. One is we got to play catch up here. And there's a lot of catch up to be played for the S&P 500 to bounce back. And the next thing you know, it's going to have a 1.5% or 2% gain by the end of this, right? Or there's actually something wrong with the market. Like there's something really wrong. Now, in order for something to be actually wrong with the stock market, you need what? You need earnings to tank. If you want to know how we got the massive bear market, crash market in 2008 into the beginning of 2009, it wasn't just like we had this problem, that problem. Earnings tanked. The biggest stocks in the market, their earnings collapsed. And the stock market collapsed. How did we get that massive crash we had in 2022? Well, look at the earnings of all the strongest companies in the stock market. Their earnings tanked. Look at the back half of 2022 through the beginning of 2023 and what happened to their earnings. Look at Amazon, look at Meta, look at all the big dogs, Tesla, blah, blah, blah. Go through the whole list of them. Their earnings fell off a cliff. And the stock market fell off a cliff. So we can always point it to treasuries or what happens with the Fed and blah, blah, blah. At the end of the day, it always comes back to actually earnings, right? Now, how am I positioning for this? And how am I positioned going into this earnings season? I have no hedges going into this earnings season. Zero. Like Robert De Niro, I took all my big, huge profits on all my hedges. I'm out. I am not banking on this market tanking on this earnings season. But with that being said, I kind of hedge a little bit. And the reason being is I got a really good cash position right now. That's over there yielding me that 4 to 5% right now, right? And so I'm not even close to all in this market. So if we do have fireworks and this market tanks, let's say for whatever reason, I'll be happy to deploy $100,000, $200,000, $300,000 into this market in the next, we can call it in February, March. Let's say, whatever happens, drama, boom, cloudy conference calls, whatever, right? No one's going to spend on AI anymore, whatever, right? I'll be ready to buy and gladly take shares off people's hands. But I'm not banking on that at all. I really think there's a lower probability of that happening, right? And I'm heavy, the top 1% type income statement and balance sheet companies. Like if you look at where I'm most positioned, it's top tier balance sheet and income statement companies, right? Why? Well, because I want companies that are making insane profits, right? So then they can take those insane profits, do share buybacks with them if they choose to, or pay dividends out to me as a shareholder. They can build their balance sheet even stronger. And the companies with the best balance sheets are the most well positioned right now because they don't have to worry about taking out debt at high interest rates. Meanwhile, they're able to generate 4 to 5% on all that cash they have, which just prints them even more money. It's a phenomenal thing, right? And even if you look at some of my weaker companies, like let's call it the smaller positions I have, right? Even those ones have positioned themselves with now very good balance sheets, right? And income statements. Like look at Honest, like their income statement has improved by 1.5 miles, and their balance sheet is now actually very, very strong for a small cap company like Honest. Their balance sheet's a beast now at this point in time, right? Fubo, you look at what their balance sheet's going to be looking like after that deal gets through. And then they're talking about being cash flow positive after the deal goes through as well. And plus their financials, they have been continuously improving prior to the deal going through as well. They're setting up well, right? SoFi, this was a $6, $7, $8 stock. Could definitely be seen as one of the weaker stocks I have, smaller position for me, right? But you look at SoFi, I think they're actually in a very good financial standing. I mean, you look at their income statement and how much that has improved, right? They're flipping over to profitability. You look at their balance sheet. You look at their leverage ratios. SoFi is looking pretty dang good. So even my weaker stocks, right, when it comes to income statements and balance sheets, even those ones are actually pretty dang impressive. Never mind my top tiers. When you look at the Metas or the Teslas or the Amazons, like some of those big dog positions I had, PayPal. I mean, those are some of the biggest money printing companies literally in the world. It's unbelievable, right? And so that's where I'm positioned. That's kind of what I'm expecting. I'm expecting more upside than downside. With that being said, if we get that downside, I got the cash ready, baby. The chambers are loaded. The chambers are loaded. No, whatever happens here, just make sure you're focusing on long term. We call that Richville. Long-term mindset is Richville mindset. Short-term mindset, all this, I got to try to get in at the perfect time. That's Brokeville, man. That's Brokeville mindset. You're never going to get in at the perfect time. You see great opportunities in the market. Take advantage of those opportunities.